All right, welcome everyone to this intro to earning strategies. So the plan here is really to give you an introduction to these option strategies that we discuss around earnings. As you know, a lot happens during earnings, more than the sort of gambling aspect of just buying calls or puts. To gamble on a direction of move. There are actually somewhat a bit more sophisticated, let's say, strategies that really revolve around the statistical and the data part of it, where we are not necessarily interested in the direction of move. We're more interested in the volatility aspect. So this is what we'll break down today. To basically follow along, etc., you really need here basic option knowledge, let's say, so you understand what are options, how they behave in a general way, and the basics of pricing, things like that, the Greeks things, and especially the notion of implied volatility, that we will break down more during the session, but it's good that at least you have the basis of, let's say, really the fundamentals of options. And so we'll try to build basically on that to try to understand, first of all, the really dynamics, what makes earnings special, and what is the context and the setup we play. And from that, really, this is about understanding the notion of IV, basically IV crush, IV rush, what happens on the day of release. Once we understand that, these strategies will right away make sense. We'll see basically the edge of it and the way to play them. But it's really important to basically understand the basics and understand the setup and the context. Okay, so let's actually start by something very simple. So we are new to earnings. We really do not know much about earnings. Let's say we know that earnings are these events that happen 4 times a year, every quarter for each company, and where the company releases basically its earnings, so its news. Its performance, the different accounting things, how things. So you can understand how these are very interesting and important things for shareholders and the markets in general to watch, because of the new info that is released. And so obviously you'd like to know how. Here we're just looking at Netflix, that released a couple of weeks ago, around that. And so on these dates, really the market is watching and expecting, these new information. And we're all familiar with, the big moves and the big things that happen after the release. Netflix loss of subscribers or gain of subscribers, or some AI work or some things like that. These really are the information that we look for. And also, by the way, keep in mind, unlike what many people think, earnings do not just happen during what we call earnings season. So earnings season is really these 2-3 weeks where the famous tech names report, where basically it's the current week, for example, for this quarter, because we have Apple, we have Amazon, we have Google, so the very famous names. But actually, what a lot of people dismiss or not really realize is that every week earnings are happening. So there's not only the famous names that release, during the season. Sure, the season gets more attention because of the famous names that release there. But actually, any other week, really, there are maybe 3 or 4 weeks in the whole year where there are very, very few earnings to play. But the good thing about earnings is that they happen every week. So you can see right away the edge or the sort of repeatability aspect of it that really we can play. As you know, the idea is really to repeat these things, is not to gamble on or to choose one position or one trade on some trade or some position on a specific earnings, but really to develop a strategy. This is what trading is really all about. This is what an edge is. Develop a strategy that we play week after week with consistency and discipline. And so just the fact that earnings happen every week, we see this repeatability where every week we can practice and execute these strategies and choose this edge. I'll really just add to it that a lot of beginners, especially so people in the audience who are familiar, or let's say learned the basics of options and the fundamentals of okay, what are calls and puts and spreads and straddles and things like that. The next step after we learn these strategies is to sort of wonder, okay, what trading strategy, what edge, this is the key word, what is our edge in the market, what are we trading? And obviously a lot of people go into what you see a lot of on social media and around the sort of first step strategy is what people call covered calls, for example, or cash secure puts, where people would choose certain stocks with certain volatility and will sell these calls or sell these puts, or maybe the spreads on them. Okay, this is a good strategy, especially a good strategy if you are fundamentally believing in the stocks you are doing this on. This is really what's important to keep in mind when we do these things, this covered call and cash secure puts. These are not really strategies that we can play on some random names or some, the same way or approach we would apply to earnings, where we would have this workflow or this research that we apply to it. Some people do, but you see that we're missing sort of fundamentally the basis of when we sell calls or sell puts on a stock, we have a position or we have some view on the stock. So we either are holding the stock, we have actually stocks in the portfolio, and so we're selling covered calls on it. And so the underlying thesis, the underlying edge here is holding the stock and believing in it, but it's really not a trading strategy or an option strategy on itself that we can repeat and rely on repeatedly. And so what we tell people is that actually earnings are a good opportunity and the good spot to exercise and to step up to these data-driven strategies, basically. Like same as some people would choose these covered calls, these cash secure puts, etc. There is a way to actually play earnings, not for the gambling aspect, not by risking all with wild positions, etc., and either losing it all or making five times the returns. Earnings actually can be this part where after we master and understand the fundamentals and the basics, we can apply that knowledge directly to this new setup. And the good thing about earnings is that a lot of things are in play: the IV, the stock move, things like that, and everything basically revolving around options. And so it's a good playground, basically, thing to get into to practice this edge. And the key word here, the most important thing, is that it's data driven. Really, it's data that will guide our research and our trade. And this is what you see us do in this channel, in our social media, with our platform, where really the statistical part that we like of it. And so in a nutshell, we sort of preach and we push that you should get more a hang of earnings and learn more about earning strategies, because this is actually a strategy that you can apply and you can learn and execute with discipline, with data-driven methodical approach. And so this is what we try to break down today and understand, to make that gap basically from, okay, we understand the basics, how do we get into earnings, what are earnings basically. This is what we will be looking at. And so as we said, okay, let's start by let's break down what happens on earnings. So here we are looking at the past moves of Netflix stock on earnings. Okay. So as you can see, and as you expect, and you must have heard in social media and whatever the release happens, this is the column we're interested in. This is the stock move of Netflix on its day of earnings, let's say. So the first day of trading after the release have been released and published. And so as you can see, something very intuitive and that makes sense to us right away is that you see these amounts of moves are not negligible. Okay, a 10%, a 5%, a 14%. As we scroll down, remember there were these two dates back in 2022 with a minus 25% and a minus 39%. Now, as you can imagine, these moves rarely happen outside of earnings or outside of special events where this new information is released, etc. The really in a random day, on a random Tuesday, on a random Wednesday, unless there is some market move or some thing happening related to the stock, etc. We don't see this type of moves. First of all, these are these moves are, and you can see that they're not negligible, they're quite big, really a special thing on earnings. So this is the setup. Okay, just looking at past history, we see that as expected, Netflix moves a lot on earnings. Okay, so from that, let's go ahead and do something very simple. Where let me share this tab now. Share this tab instead. Now we're looking at the option chain for Netflix. Here we're looking at the free data of Yahoo Finance. Now Netflix, keep in mind why are we looking at it? Because it had its earnings not too long ago. Okay, so actually on the 21st, as we were able to see in the other screen, and so in the next weeks, in the next days, in the next weeks, Netflix is not going to be releasing earnings. This is basically the idea here. And so this is classic market conditions for Netflix. There is really no earnings announced for the upcoming weeks. The next earnings in February or January or something like that. And so let's do something really simple and actually look at the the options chain of Netflix, and let's see. Now, as you know, there's this notion of implied move. So implied move, you hear a lot about it on earnings, but this actually is a notion that is general to option trading. What is the implied move? It's really as simple as the break even of the position. Okay, meaning that if I buy a call, if I buy a put, if I buy whatever, what is the amount of stock move that needs to happen for my position to break even? Okay, for me to make money on whatever I bought. And so, for example, if we look at Netflix and we look at the closes at the money call or slightly out the money, so the stock price, that stock price before close is 1,089. So let's say, okay, if we bought the 1,090 call, let's see that the last price is $7.25. Now we can do very simple math to find its break even at expiration. As you know, is to divide the option price that we paid for by the stock price. Really, this is as simple as that. But again, this is the expiration, the break even. Sorry, at expiration. So if these are weekly options, so we're looking for this Friday basically, and we're doing this math to find out, okay, what is the amount of move that needs to happen for my call to be profitable. So this call, the 10,090 call for this closed expiration. In a nutshell, by the way, between brackets, you should know this. So if you really studied the basics of options, but this math, this calculation of doing the division, divide the option price by the stock price. What we're doing here, we're trying to find a percentage. By the way, keep in mind, we're dividing, an option price by a stock price. Why we are doing this? And to find the percentage of move of the stock move that needs to happen for us. It's really, we're looking at the intrinsic value that this option needs to have for it to be worth what I paid for, basically today. In other words, today to buy it, it will cost me $7.25. Okay, by expiration, basically there needs to be the $7.25 move, as in a sense, if you like, for my options to be in the money. Because remember, at expiration there's only intrinsic value that stays. And so I'm looking at, okay, what is the ratio I could be doing? 1,089 plus 7.25 divided by 1,089, and there I will find the difference basically of the stock move, to say this is where the stock needs to be for my option to have enough, or this amount of intrinsic value, this amount of intrinsic value that will be its only value at expiration, and I need this amount to match what I paid for. I need it to be at least at 7.25. This is really the logic behind this calculation. And so we do this math for the 1090 call. We find that it's really a 0.06% move basically. So the stock needs to move only by 0.6%. Now this is done for the call basically of it, so the 1090. This is a directional position, as you know. Now we can scroll down to go look at the puts, and basically now let's look at not just one call or one put. Let's actually look at both of them. This is what we call a straddle, a strangle. You must know this. These are really now positions that are exposed to both directions. So it's not really the direction that matters for us, it's the amount of move. Again, this is a concept we use a lot in earnings, but it's really also general to options trading. And important to understand that, okay, now if I buy the 1090 call for 725 that we looked at earlier, and now also add to it the 1090 put that is, you see here, 756 is its last price. So let's do the math of, okay, if I have both of them, now what is my implied move? What is my break even? So I basically add those two premiums together and divide by the stock price. Here, what I'm saying, what we're looking at is, okay, obviously the stock will either move up or move down, okay? And the idea is that it will move up enough or down enough for one leg, the call or the put, to be profitable enough, and so to compensate for whatever I spent on the call and the put together. Really the assertion is that one direction will take it all, basically. And so when I do this math of adding both call and the put price, the premium that I pay for, and then divided by the stock price, I'm doing the same math as we did for just the call just earlier on, which is, okay, this is the intrinsic value that needs to happen, and needs to be either on the upward side or the downward side. But basically, this is the where the stock needs to be for either the call or the put to make enough. Again, we're looking at expiration, to make enough in intrinsic value, because this is what will happen, will be at expiration. And so I need that amount to, again, counter what I paid for. And so what I paid for is the 725 plus 756 that you see here. And now when we do this math, so both of them divided by the stock price, we arrive at 1.3. Again, bidirectional, so plus minus 1.3. Now this means that, okay, basically for the stock for my position of a call and a put, and this is what we call a straddle or a strangle as we go out of the money, we need a plus minus 1.3% to happen. Okay, now let's get back to the past moves that we were looking at, and now things will start to click together. The important thing that we were looking at the option prices, but for Netflix, that, keep in mind, don't have earnings in the next weeks. Okay, there's no expectation of these big moves or of this earnings. We're doing a theoretical case just to see, and so we found that our break even is 1.3 basically. So really 1.3% up or down will make my straddle profitable. And you see, it's quite a little. Now let's do this theoretical experience in our mind. Let's imagine that actually the option chain we were looking at, and today as a date, let's imagine that Netflix actually has earnings tomorrow or next week, let's say in the upcoming days. Okay, let's make it simple. Let's imagine Netflix has earnings tomorrow, okay, or tomorrow after close, so we still have one day to go or something like that. Okay, now you are interested in Netflix, so you go ahead and you check the option chain like we just did, and you find this plus minus 1.3%. Again, imagine we are set up where earnings are happening tomorrow for Netflix. And so now you do this very simple, thought or analysis that, you wonder, okay, as we started with, what is the usual move of Netflix on earnings? You really like to know that. You see how, by the way, now that break even is, we understand this amount of move aspect of it that will link to this break even. Basically, the option price, the market is pricing in a plus minus 1.3% that we found from the, again, option prices of the call and the put. So the market expectation for me to make a profit on my straddle is a move of plus minus 1.3%. Now, if I look at what actually happened on earnings, I see that, okay, the last one was 10, was 5, the other one was 4, 14. As you can see, there's really never a move under 3%, let's say, for Netflix. We can scroll down to look at the distribution. This is the distribution of moves. Okay, the biggest occurrence is a 6%, basically. You see a 6% drop. On the other side, the actually biggest occurrence is an 18% move. Okay, the average move on earnings is 12%, 12.3, and the standard deviation is, this metric about dispersion, how wide is basically this distribution of moves. 8.4, so quite big. As you can see, the range goes from -40 to +44, big range. And so, if again, in our theoretical experience, in our thought experience that we're doing now, if Netflix earnings were to be tomorrow, now obviously, if you look at the option chain and you find now that the straddle is only pricing in 1.3%, 1.3 is very, very little, very, very undervalued. Really, you look at the last moves. Basically, it's as if the market is only pricing 1.3%. As you see, the average move is 12%. So obviously, there's no brains here. You will want to buy the straddle and hold through earnings, because sure, you need only 1.3% move to be profitable. And look at the past moves; they are wild compared to this 1.3%. And so now, obviously, a trader in this position will go ahead and buy this straddle. Now, what we see here in this thought experiment is really the process behind what happens on earnings, where as earnings approach, so we're here taking the theoretical or imaginary case of Netflix reporting tomorrow, let's say. But as earnings approach, so next week, the week after that, etc., traders and market participants, let's call them, who participate in the markets, will take a look, would be monitoring the option chain. And so, as if we were in a position where as the earnings are approaching, people will be seeing this low break even. And again, remember the Netflix 1.3%, but outside of earnings. Now, as earnings will approach, people will actually start to take positions on these straddles because they see this very favorable opportunity we just looked at, 1.3% implied move versus, as you can see, the moves are very wild. And so the first trader will come in and will buy the straddle, the second one, the third one, a herd basically, and you can see this frenzy that will build up little by little to buy these positions and to, as you can see, straddle, strangle, calls, or just puts. But basically, people will be interested in playing these earnings while the options are cheap. But then, as earnings approach and this frenzy continues, now what we found as 1.3% will get higher and higher. Why? Because obviously, offer and demand, as when anything is in life, when something is demanded and there's a lot of buying pressure on it, its price will rise up. And so the option chain we were looking at will see its price basically go higher and higher. And now that inflation directly, we see it going higher and higher. Let's get back quickly at the Netflix option chain. It will mean that this 756 for the put basically will be worth more. 758, 788, 8.1. This is really the effect of people piling in and driving the price up. And so, in our calculation of break even, we find now that these inflated prices, when we add them together, we will rise this 1.3%. We will go to 1.7, 2.1, 2.3, etc., until a certain level, obviously, where at some point, so for example, let's do the thought experience again. If things keep piling up, and now let's say the implied move, the break even that we did from these option prices, is at 20%, 30%, or 50%. Really do the imaginary case here. Well, obviously, if it's at those level now, and since I know and we looked at the past moves that happened, well, less and less people would be interested to take this position. Let's just say if the break even is only the break even is 50%, plus minus 50% for Netflix. Okay, sure, it's a wild stock on earnings and moves a lot, but not 50%. So not a lot of people would want to buy this 50%. So you see that there is a dynamic really where basically people buying in the options before the release inflate those options and make the break even, make the implied move that you see in our weekly calendar and our daily graphs and all over our content. That implied move will basically inflate and rise to catch up to a certain value where the market, and this is the magic of the market, the aggregated result of all market participants, to a level where at some point, okay, people believe it's enough now. Okay, more than that is not really worth buying, getting in. Really, same type of experiment we did, where you come to see the options chain for Netflix, you look at the option prices and you find the break even, and you say, okay, actually not interested, it is too high. This is how the market will equilibrate itself between people who believe it's not high enough and people who believe it's too high. And when they both arrive at equilibrium, basically to say, oh, the market now believes this is the amount of the expected move, and this is now the implied move of Netflix that you find all over the place. You see here in our platform, the last implied move for Netflix of the earnings last week was 8.3. So, by the way, notice how there is a coherence in the expectation. So the one before that was 7.2, the one before that was 8.5, 8.3, 7.6. And so the market expectations for the last year seems to always land at the same level. Seems like there is a consensus where people buy in to inflate these option prices to arrive at these 7-8% basically. But also see how the markets can anticipate things. If you scroll down to look at October of 2023, we see that the implied move was actually just for that occasion a 12%, which is directly 3% higher than just the previous one of 9. So you see that also, this is what really interesting about earnings, is that it reflects the sort of common or the market view of things. And so during this earnings 2 years ago, forgot the exact news, but obviously there were things happening that made the expectations for Netflix higher, meaning that the same case we discussed where for the last earnings people settled for 8% implied move. Well, the 2 years ago, it seems that at 8%, basically there was more buying pressure, and even traders coming in and seeing the break even, the implied move being 8. Most of them, the majority, decided that it's not enough. Why? Because something was happening with Netflix back at that specific period. Something, some extraordinary expectation about something that will be announced in this specific earnings. And so when we saw that 8%, it was not judged high enough, unlike the earnings 2 years later on, just last week. And so it kept moving up. More people kept buying and buying for the implied move to reach this 12% basically. And you see how you see a sneak peek on why earnings can be interested, because you see right away it is, and this is why we say it's a statistical edge, data driven, because it's basically the market is taking a position from this all aggregated behavior, etc., to settle at 12. But the market is not very rational all the time. The market does not always well price in things, basically, especially not on earnings. And you see that even when the expectation got higher at 12%, the actual move was an 18. Okay, so the market was right by rising the expectation, but it completely missed the level by which it will reach. Funny enough, this is a great example to also understand this notion, is those famous two earnings where two drops of 25 and then a 39%. And so at the drop of the 25%, the implied move was 9%, right? 9%. So the market expected 9%, meaning again, people buy in, the buying pressure inflate this option prices to reach 9%. The market was blown away. People were blown away by an actual move of 25% happening on that day on 2022. And so you see that the next release 3 months later of April, well, now look at these expectations, 33%. Meaning that we went 3 times ahead. And why? Because, well, the market is not stupid. Meaning people, participants in the market are not stupid. They saw basically that, whoa, okay, Netflix that, if we scroll down, before those years, was somewhat calm stock, 3%, 4%, okay, an occasional 18% here and there, but not really a big mover on earnings. And then suddenly this 25%, and I think this was the last time where Netflix lost subscribers, if my memory serves me right, or maybe I'm wrong of the date, but it was a very big important announcement for Netflix, so a huge drop. And so the next earnings quarter, when the release was going to happen, people were logging in, seeing that implied move, and so the option prices, and they saw the 9%, not enough, 10, 11, 12, even at 13, at 14, even at 20%, people kept believing that it's not enough. Actually, even more than 25, even at 30%, people kept pushing the price up to arrive at this very wild break even of 33%. And obviously, this is a situation that's not playable. It's like it's two very hard-minded sides. The market that now went crazy with the expectation at 33%, but obviously for a stock that just did a 25% drop on its earnings for the first time ever, you cannot bet against it. And see what happens is that against expectations, well, it went even further than the 39%. So you don't want to be really just a sideline in between brackets, but in these situations where the implied triples from earnings to earnings, these are cases you don't want to touch. You don't either want to buy or sell options. You don't want to take any position, because both sides, the market expectation and the stock moves, are just going wild. And so we need things to again, for our statistical and data driven approach, we need things to cool down and to get a better picture. But then from that, you see that things stabilized a bit, and we arrived at this usual 9% implied move. And again, keep in mind here, it is the result of the frenzy of the people piling up, the pressure power that who's basically winning? Is it traders and market participants who believe it is not high enough, the option price is not high enough, the implied move and the break even is not high enough, and so it is still worth a shot, until the it flips, and so now a majority of people believe, okay, it's enough, actually it's not, it's quite high, and people stop buying, and so it stabilizes at that level. This is very important, the most important aspect or dynamic that happens on earnings of this rise in IV, and so this rise in option price. And so I said it early, but as you imagine, how can we inflate an option price? Keep in mind, okay, what can be the reason? What can be the driver behind an option price? Let's go ahead and look here at and open one of the stocks on, or actually, I think it is better that maybe we should go right here and look at a graph that will help us understand in a better way how this pricing inflation in prices happen, basically. So let's take a look at, actually, perhaps it's easier. Let's go ahead to find 1 second, so we can find this a graph of how an option price behaves, basically on earnings. Is this enough? Okay, this is a good one. And so what can be the reason of let me share this tab instead. So what can be the reason of what can be the driver of the inflation of option price? Well, what does affect option price to begin with? There's the classic, so theta decay. This always eats at the position when you buy it. Time will always eat at your position, and so it will impact your option price, but sort of in a negative way. The other thing is the stock price, obviously. So if you have a call, the stock price goes up, your call will be profitable. But then this is not the driver. This is not what's going on for what we're deciding. We're looking always at the money calls and puts, and this aspect of options inflating does not happen at just one strike or two. It happens at all of them, basically. All of them get inflated. And so the less suspect, the driver of this inflation and this rise in the price is the IV, obviously. And as you understand it, if you learn the basics, etc., that IV is sort of this proxy that tells us about the market demand, if you like, how this frenzy we called. And so, as you know, IV is something to look at by strike and by expiration. You cannot really compare it between different positions, and you can basically only compare it to itself, its past values, and see how the current IV compares to how it is. So when IV gets higher, it means that there is this frenzy, there is this rush, we arrive at the word, where people are buying in a not normal, in an unnormal way, basically, these options. And so to account for this abnormal behavior, IV will inflate, and so you will see that IV inflation. Now, what we're looking at here is a graph that actually shows this at the money IV. Let's focus on the classic, the black curve, so which is the at the money historic IV. This is, I believe, for Intel. And so notice how 5 days leading up to the release, IV starts to rise, but slowly. So 5 days, 4 days, slowly rise on the third and the fourth. But there is a big, basically, you can see visually this effect of this frenzy and this piling in this, buying power that pushes the option prices high, and you clearly can distinct how the black curve, this at the money IV, really saw this rise. So it really started the day at around 120, 130, and it ended up at 150. This is purely from, again, this piling up, and this was basically driving the options prices, and so the implied move. Now, keep in mind, the implied move here at open, 1 day before, so there's only 1 day left to trade before the release. The implied move was quite high already, because there has been a rise happening for days and weeks, basically slowly piling up. Here, to understand things, we're really focusing on the last day and seeing that effect, the same effect that happened on the longer period of even up to 2 weeks or 3 weeks before the release. We can see it in a concentrated way in the last hours also, that where the same phenomenon of what we call a rush, basically, into playing these positions happens gradually over a long period of these 2 weeks and so. But also in the last day, in the last afternoon, you can see it visually how there's also a reminiscence of it and another rush. Some people refer to this as rush hour, basically, where it's really the last moment, especially when it's the last day of trading before the release. And so this piling up happens, and so the implied move got higher purely by this IV, by the fact that it's driven by IV. This is the important dynamic that happens on earnings, and that makes the expectations on earnings be more and more be higher than a random day. This is really the gist of it. And then as earnings are released, and finally, so the stock is the information is out there, and so there is no more of this frenzy. Really, intuitively, you can think of how this buying power we were discussing, and these traders and market participants piling in. Now, once the release has been out, obviously there will be much less piling in, and so this aspect will need to be translated in the option prices in a very simple way. Here we're looking at our option simulator, so to understand things more thoroughly as we go through earnings. Actually, as you can see here, so for Palantir Technologies releasing next week. Now imagine this 200 call, for example, or any actually call, even the close of the money is 195 before earnings, and this is the case for Palantir, that still has 2 days before it's released, because it's releasing on I believe Monday after close, so it's Tuesday, the first day of trading after a release for it. Well, you can imagine, or for Netflix, in the imaginary case we will doing, the same applies, but this frenzy where here you see that this call price is 10.1 with this IV of 86% that you see here before earnings. Okay, you can imagine intuitively that there will be much less demand and much less people interested to buy this call in general, in conception, after the release than before, basically. And this behavior is what is translated into options prices, where now this whole inflation, a normal inflation of IV that we looked at, especially on the graph with Intel. Now, when it's the IV was here for Palantir is 86%. Well, obviously it needs to drop, and so that drop, the drop in IV that will happen on the first day of trading after release, obviously will drag down the option prices with it. And so you see here in this case for the 195 call, its IV is 86. By Tuesday after release, its IV will drop to 58%, basically, directly decimated by near a third, basically. We do this math. There's a way to find this calculation and do it by striking an option. This is what our simulator does. But to give you an idea, this IV will drop to this level, and so you see really, to wrap up and encapsulate and summarize things, is there's really a dynamic of IV rushing, people piling in, and then IV dropping. And as you now understand option prices, it's really, if IV didn't drop, the implied move will not be that high, because keep in mind, every part of the what we're discussing here, the part that inflated, and perhaps that we didn't say all along, is that the part that is inflated in the option prices, where IV intervenes, is not the intrinsic, it's the extrinsic. And so when we look at our break-even, etc., we're not really looking at the extrinsic value anymore. We're looking only at the intrinsic. And so it assumes that IV and its crush, its rush, whatever, its impact in the extrinsic value is gone, basically. So this is why we see this large amount of moves when we do this calculation, you remember, of the option prices divided by the stock price. We see the break-even at expiration, and we see a large break-even because there's this whole IV dynamic inflated the options you bought now, right? And so now, if you want to make money on them, you actually need that whole value that you bought, that whole price that you bought, with a lot of it being extrinsic, you need it to be actually all in the intrinsic. This is a way to understand it, basically, because this IV is not normal. The IV of the on which you bought this call at 195 here for this example is not normal to be at 86. Usually it should be at 58, sure, okay? And so if you look at the expiration, the break-even at expiration, you'll be dividing the option price by the stock price. The option price is very inflated. It has an intrinsic value, a normal intrinsic value, but then a very unnormal, a very inflated extrinsic value. And so now it's upon the only factor that can compensate and make up for your price is the stock moving to this level, basically. And so this is why, for example, for the score, as we scroll, this calculation, and so here we do it even day by day, but if we look at the last, so Friday of this expiration, it's a 3.6%. See, so there is an expiration there. And actually, as you know, we looked at calls and puts, we looked at straddles when we looked at these positions. And so you see, what we calculated to be 1.3%, remember, for Netflix early on, it's now at 10% actually for Palantir, because it has earnings. So people piled up and inflated the price to arrive at that 10%, to inflate the IV to this level of 88%. And usually this IV, it should be at 59. So after release directly, the IV will adjust. And so to compensate for this adjustment in IV, you need the stock price to step up, basically. And this is why again, another way to understand how the break-even is high, because remember, there's only three factors: there's theta decay, there's the stock price, and there's the IV that have an impact on the option price concretely, and for our cases. And so if IV moves a lot, in this, because of IV crush that happens, as we said, on the release, 88 to 59 here, well, now the stock price needs to step up and compensate for it. Keep in mind, IV crush will be added to the theta decay. Obviously, you see how here is this straddle price going through earnings. So for the whole week, for a scenario of the stock not moving at all, okay, 0% stock move. So the factor of the stock move here is neutralized. You see the effect on the first day of IV crush plus theta decay, so a big drop. And then the days after that, leading to the expiration, it is sort of the same time of drop of theta decay. And as we know, theta decay gets bigger on the last day before expiration. And so you notice why this drop is a bit sharper on the last day than the day before it. But earlier this week, since the earnings for Palantir here is on Tuesday, well, Monday to Tuesday, you'll see theta decay plus IV crush, and so the stock move needs to be big enough to counter both of them. Voila, this is sort of an intro to the dynamic, really the important dynamic of this IV rush and IV crush. Once you understand this, you understand really the fundamentals of how to play earnings, and you start to see the picture of how the data intervenes, because you see that these market expectations are not always correct, obviously, and so some stocks move a lot, some stocks move way less, and actually by studying the data you can arrive at finding opportunities. I want to show you here just a quick example that we had perhaps of a stock that where actually Palantir is a good example, where you see there is really a mispricing happening, where it either beats a lot its implied move or doesn't beat it by much. So you see how we can find this edge comes really from benchmarking this type of data versus the market expectations. But it's really important to understand the basic of how IV basically drives these prices and what we're up against. And so as you understand, these three main strategies are what happened before release. What is, you saw our post about riding the IV rush, and then through the release there's also, as you can see, the part where we bet against IV crush or for IV crush. Basically, we either agree with this market expectation or disagree with it. And you see how studying the past moves and the general outlook help us find these edges. And this is what we do again, remember, week after week. The advantage also is the repeatability of this process. So hope the session was helpful. Feel free to let me know your questions in the comments or in our server, etc. Happy to help you guys. And so I'll see you in the next session, where we'll develop more perhaps examples of these different strategies, the IV crush, betting forward against what we call long and short volatility. But really make sure to for example, practice and watch these upcoming earnings. So, and notice this trend in IV, try to paper trade positions on your own, etc. This is the best way to get a hang of things. And again, earnings are a good opportunity and a good place to play, because data really helps us see things basically and quantify things, so we know what we're doing again. And the fact that a lot of earnings happened, and so a stock like Intel or Google, whatever, has been around for years, and so we have plenty of data of how it behaves, and from that we can derive our statistics that will help us in this research and edge that we find. Thank you all for watching, and